We believe in the current interest rate environment that investors are actually rewarded by adding credit exposure to their portfolios. Interest rates are at all-time lows or close to, and really government bonds don't really represent a good risk-reward trade-off for investors anymore. So we do think they should be adding credit exposure to their portfolios. Really, in a government bond, you only really have interest rate risk, and we do think interest rates will rise over the next few years. So therefore, we think investors should be lowering their duration and adding in credit exposure. Depending on the risk tolerance for investors, we do think investment-grade corporate bonds represent a good choice, but we believe even better than that is actually high-yield bonds, so bonds that are BB or B rated by the credit rating agencies, so considered to be high-yield bonds, offer an even better risk-reward because they have a very low duration and very high yield. You're looking somewhere on the index around 6.25%, 6.5% with a duration only about 4 years. When you compare that to the Canadian government 10-year bond, you're looking at an interest rate risk of 9 years and a yield of about 1.3, 1.4. So there's a significant pickup by moving down into the credit spectrum. So we've seen a huge drop in the oil prices over the last 6 months or so, pretty much $50 or 50% drop from the highs. There was a little bit of an exaggerated sell-off, so we do believe energy is starting to look very attractive as an investment opportunity. What it also does for the economy in general is actually gives everyone kind of like a quasi-tax break where the average consumer now has an extra $20 or $30 in their pocket every day. Instead of the money essentially flowing up to the energy companies, it stays with the consumer. Generally, if you have an extra $20, you're going to go get an extra coffee, or you're going to take your wife out to a restaurant or go to the cinema. Lowering interest rate risk, having less sensitivity to the interest rate increases, and having more exposure to corporate balance sheets is really something you want to look at for the next 2 to 3 years. Generally, the market's always wrong, it's always mispriced, the market always overreacts or underreacts, and therefore there's always an opportunity to make money, you just need to go and find it. We're very transparent about what we do and how we do it, and I think generally investors appreciate that.